This is Bloomberg.
Steve Chevron of Federated said three things that should not exist at the same time. 7.5% inflation, zero rates, and a Fed still buying bonds. 7.5% on CPI, upside surprise. Equities lower. Equities down by 2% on the Nasdaq, on the S&P by 1.36. There's your opening bell. What's the cheering for? Switch up the board and get to the bond market. Your 10-year yield higher, much higher, by 4 basis points to 198, just short of 2%. Don't just look at this. Look at two other things. The relationship between 10s and 2s, and look at where 2s are right now. 2s up 11 basis points to 147 on the year so far. We're up 74 basis points year to date on the 2-year yield alone. The 10-year up about 47. This curve is flatter on the year. It's flatter this morning. The FX market, the dollar stronger. Euro dollar breaking 114 again to the downside. 113.85 and down a third of 1% there. On WTI crude, 89.70, just about holding on to some gains. Up 4 cents, up 7. Let's call it a tenth of 1%. At the open, 40 seconds in, your equity market down 1.2%. Energy, the relative outperformer here, down 0.2 of 1%. Every single industry group, though, in negative territory. Information technology down by 1.9%. The rate story not helping the cause on that front. Earnings season picking up. 70% of S&P 500 companies are already in. Let's get to Katie Lyons for more. Hey, Kaylee.
Hey, John. Well, we've had a lot of reports over the last 24 hours, including a couple this morning from Pepsi and Coca-Cola. Pepsi, the story really is strong on demand, really strong sales number, but you are seeing that margin pressure due to higher costs. As a result, that stock is down about 2.4%. You also have Twitter moving lower after initially a big gain, missed on some metrics, even though it did institute that $4 billion buyback. It's lower by more than 3%. Disney and Uber, though, moving to the upside after pretty blowout reports. Disney, you can thank Parks as well as subscribers for its 6% gain, and Uber is moving higher as well on record number of riders. When you put it all together into a more holistic picture, we are more than 2/3 of the way through earnings season so far. Average profit growth of about 27%. For sales growth, about 16%. Majority are beating on the top and bottom line, but as far as those beats go, profits are only coming in about 6% ahead of expectations. Are those upside surprises as big as in the previous quarter? The answer is no. Is the growth as strong as the previous quarter? The answer to that question also is no, but we knew that was going to be the case going in, and it does seem earnings by and large so far have been good enough to provide some support to this equity market. At one point in late January, we were down 9% on the year. As of yesterday's close, we were down less than 4%, so earnings definitely have helped over the last couple of weeks. So obviously we're extending those losses this morning, John. Hot inflation data seemingly overriding anything we're getting on the corporate side, John.
And that's the focus of corporate America and international corporates too. Kelly, thank you for that. We caught up with the Unilever CEO, Alan Jobe. Take a listen to what he had to say on margins and on costs.
We think it's going to peak in around the middle of the year. We're anticipating about 2 billion euros of net material inflation in the first half and another 1.6 billion euros in the second half. The second half is obviously more uncertain than the first half, and we think it'll start to taper off towards the end of the year.
That's the hope. Prem Isra, David Kelly, Srogaevsky back with us. David Kelly, on margins, they held up really nicely last year. Can we repeat the act in 2022?
Well, I think the problem's going to get worse and worse as the year goes on, because if you think about interest costs and you think about wage costs, they're both heading in the wrong direction for businesses. And I think, there's such a surplus or such an excess demand for labor right now. We've got 10.9 million job openings. We've got 6.5 million unemployed people. It's going to take a long time to get that back into balance. And for as long as there's this excess demand for labor, it's going to keep on pushing wages and therefore costs up on businesses. Meanwhile, they're going to have to deal with higher interest costs, and total revenue growth will probably slow as the year goes on because of slower economic growth. So I think it's going to get tougher and tougher in terms of margins. Year over year, it may look okay in year averages, but fourth quarter over fourth quarter, it's not going to look as good.
Troy, there's an index story, then there's a single name story. It just depends who you ask at the moment. How do you approach that question?
Yeah, in terms of single...
just on margins, Troy, just on margins on single names at the moment. Chipotle really held up. They're saying that they can pass the costs on. No pushback from the consumers. Others don't have that luxury.
Yeah, I mean, I think it really gets back to which area of the unemployment or the remaining folks that are unemployed can return to the labor force, right? So in service industries, even though you have seen more wage inflation recently, the starting point was so depressed based on where we were coming out of the pandemic that folks or places like Chipotle haven't felt it as much. but others that are in much tighter areas like financial services. I mean, if you think of the bank earnings that came out earlier this year, I mean, you saw wage pressure substantial because that was already a very tight labor market, and clearly there's tremendous revenue growth there. So, sector by sector, it's a much trickier environment to just make a wholesale top-down market call on margins. But when you look further at sectors, those that are attracting laborers back in still somewhat depressed areas should experience the least margin pressure.
Priya, you heard it there from the Unilever CEO. He hopes at the middle of this year, the back end of this year, things start to fade. Is the calendar on our side here as the year progresses?
I think there's a lot of pressure on the Fed with the high inflation numbers. So I think the calendar is on their side if they can start slow, if they can somehow, start the process of tightening on the balance sheet as well as on the rate front, because then they may not have to do as much in the second half of the year. They do need to start, then you do need to clarify, particularly on the balance sheet. And if they're slow on that, I think then the calendar actually can work against them because inflation is going to stay high for a while. And, we're seeing it in service, so it's broad-based inflation numbers. And then the market's going to force the Fed's hand to go much faster, to go 50. We're now pricing in more than 50% chance of a 50 basis point hike in March. And we don't think they go 50. Not clear that they need that shock and awe on the rate hike front. But if they start talking about the balance sheet and suggest that that's happening sooner, they can get the long end of the curve, those long end interest rates, which is actually what drives financial conditions as well as the economy, is what happens to the 10-year, not so much the 2-year. So I do think it's going to depend a little bit on how the Fed's using their tightening tool on the balance sheet to allow them to get some time, to get some breathing room in the second half of the year.
199 on 10s right now on 2s, up 12 basis points, approaching 150 to 148.70. In the States, we're down 1% on the S&P, on the Nasdaq down 1.4. Some relative outperformance in Europe. The equity benchmark in Frankfurt, Germany, the DAX right now, down about 1/10%. Looking at that story, here's Abby.
Well, John, some strategists are wondering whether there's some place to hide from inflation and whether Europe might be the spot, but inflation does appear to be a global phenomenon for sure. In fact, it appears that this is more a stock pickers market, a company by company situation. PepsiCo, as Kayleigh was talking about, hit by lower operating margins. Coca-Cola, on the other hand, managing just fine, high volumes. Pernod Ricard, they did well, and they even did a nice buyback, stocks down a little bit, but nonetheless managing. On the other hand, we were just listening to the Unilever CEO and one analyst calling their margins ugly. So it comes down to the consumer, what they're willing to pay for. And it's super interesting in terms of brand names and other need-to-have items. Consumers are willing to pay up. Tyson the other day reported a big quarter as consumers do absorb rising meat prices, beef up more than 30%. Harley-Davidson put up a great quarter and outlook on rising prices as investors want those motorcycles. Peloton, Estee Lauder, and Chipotle, of course, everybody talking about the guac shock, that they are passing that along, and consumers happy to pay more for their Chipotle. However, between Europe and the S&P 500, I should say the stock 600 and the S&P 500. The S&P 500 actually has more than 300 basis points of margin cushion. So from a macro standpoint, perhaps the U.S. is the safer bet. But again, John, it seems right now we are coming into a period of dispersion and a year of stock pickers' delight.
Abby, thank you. Higher rates aren't always bad. Look to Europe. We've been complaining about low rates for a very, very long time. The banks in Europe at the moment up 15% year to date. David Kelly, I want to come to you on that. Can we unlock some value in Europe with a conversation about rates going from negative to positive?
Absolutely. I mean, the ECB has had the wrong policy for years. Negative interest rates don't help anything in Europe. And so, paradoxically, Christine Lagarde is finally worried about 5% inflation in Europe, and people are beginning to price in finally, getting out of negative policy rates in Europe. But they should have done it a long time ago. And as they do it, I don't think it's going to slow down the European economy. And the other thing is, Europe has got much better labor force growth, oddly enough, than we have right now. Their labor force participation rate has been rising for the over this century, while ours has been falling. So I think Europe's got a lot of potential to grow faster. I don't think higher rates in Europe are going to hurt them because they're just, at such low levels right now, they're counterproductive. So I actually think Europe can benefit from higher rates.
Troy, do you agree? Just in terms of the makeup of the indexes here, look to the Stock 600 and what it's weighted to. Look to the S&P 500 and what it's weighted to. If we're having a conversation here about higher rates, does it make sense to be in one place as opposed to the other?
Yeah, so I totally agree with your guest comments on the counterproductivity of negative rates. We've been talking about that for years. But back to the constituent parts of the equity markets, right? I mean, in an environment where the biggest concern is multiple compression, particularly for companies that are priced at very high price to sales levels, you want to minimize that. Whereas in 2020, 21, you wanted to maximize that. And if you look over at Europe, it's a complete opposite. It's really a value/cyclical market where you just didn't have rich multiples to start with, and in many cases can benefit to some extent for stronger cyclical growth in the near term. But I'll say, all that being said, Jonathan, this really isn't that complicated now. You should put as much capital as you can in floating rate strategies that can actually benefit from the Fed hiking, as opposed to getting too carried away with geographic.
Well, Troy, let me jump in because you make it sound very easy. How hot is that market? Isn't everyone in that trade right now?
Well, it depends. So you have seen outperformance in levered loans this year versus high yield, but it's a rather paltry level of outperformance. And if you look over at private credit strategies where you're still earning somewhere between 4 to 4.5% in a net interest margin, whether it's corporate loans or senior secured commercial real estate, given the vastness of those markets, we think that's someplace that you can still deploy capital, not tens of billions of dollars, but certainly multiple billions throughout this year, and have a very better outcome than you have in the vanilla fixed income market or broader equity markets, whether it's the U.S. or Europe.
Getting two comments right now. One's a political one. The other one is a market one. The political one from Senator Manchin: the Federal Reserve must tackle inflation, quote, head on. This one are the markets from Scott Minerd of Guggenheim. And I want to give you the final word here, Priya. This is what he had to say out on Twitter moments ago. The market should prepare for a 50 basis point hike in March. If only 25, expect another move in May. Now, the first line, Priya, sounds controversial. Isn't the second line basically consensus? If we get 25 in March, we're coming again in May?
I think so. I think it's these consecutive hikes are likely to happen until inflation shows signs of deceleration. Is that second half? Is that next year? I think that's the open question. Yeah, absolutely. We think that they will undertake consecutive moves, but he's not bringing up the balance sheet, and I think that's another big one. The Chair Powell said that they've been discussing it for a while. I think we get some information in March, and in May, along with a hike, I think they announce balance sheet runoff, and we'll be watching for, is it 100 billion or 90 billion a month that runs off? That's a lot. It adds up to more than $1 trillion a year. The deficit is $1 trillion. And we're talking about another $1 trillion of duration that the market will have to take down. So you could actually get far more of a market reaction on quantitative tightening, on balance sheet runoff, than if the Fed hikes 25. But yeah, we're definitely in the consecutive steps of tightening that the Fed's going to take. We're just not sure that they start with 50.
These numbers are huge, and they want it to be like paint drying. They talked about this in the same way last time around, and it was anything but drying paint. Priya Misra, David Kelly, Troy Gayeski, fantastic to have the three of you to respond to an historic inflation print in America, 7.5%. Coming up, surging prices putting the spotlight on corporate balance sheets.
We live in an inflationary context on raw materials and cost of goods, but as L'Oréal has a growth margin of close to 74%, first of all, we can absorb some of these extra costs.
The View from the C-suite coming up next with PepsiCo CFO Hugh Johnston. Looking forward to that from New York. Equities down hard, yields up and up a lot. This is Bloomberg.
On a wide basis, we are seeing cost go up, and it will be with us for a while, particularly the cost that is associated with ship leasing, where we have had to pay much higher prices for container ships that we lease, and that will stay with us for quite a while.
Rising costs, they're front and centre this earnings season. Strengthening demand allowing companies like PepsiCo to pass on higher prices to consumers. The CEO saying the following: we expect to deliver 6% organic revenue growth, which is at the high end of our long-term target range and implies a strong acceleration in our organic revenue growth on a 2-year basis. I want to get to Abby for just a little bit more. Hey, Abby.
Hey, John. Well, you know, the stock is well off of its lows. The shares of PepsiCo down about 0.4% off the 2.8% decline lows of the morning. That has everything to do with a good quarter on the surface. Earnings basically coming in line. Revenues beating by more than 4%. That organic sales growth up 6%, beating the street. They're also rewarding shareholders with a 7% dividend increase and a $10 billion buyback. But beneath the surface, it's all about that inflation story. Inflation rearing its ugly head in every segment, in particular North American beverages up 37%, Latin America, Europe, and of course sugar being a big culprit there, up more than 30%, aluminum too, I believe. But again, the good part of the story here, very, very strong demand, revenues beating by 4% and rising 12% in that fourth quarter that was just reported, mainly having to do with rising prices, but nonetheless very strong demand, John.
Abby, thank you. Let's talk about these earnings, that commodity pressure as well. We can do that with the CFO of PepsiCo, Hugh Johnston. Mr. Johnston, always great to catch up with you, sir. I'll let the words of Callum Elliott of Bernstein do the talking. Sales growth, quote, truly astonishing. Margins, quote, surprised significantly to the downside. Let's start with the former, then we'll do the latter. What's driving this really robust demand for you?
Well, it's interesting. Good morning and good to be with you all. Right now, the consumer is very much responding to the investments we've made in brands, the investments we've made in product development and innovation, and they're coming to our products. We're gaining market share in most of our markets in both snack foods and in beverages. And what you saw for the quarter was a 13% revenue increase in convenient foods and an 11% increase in our beverage business. So consumers very much in a world that's stressful and where people are looking for simple pleasures, our products provide those simple pleasures and give everyone a little smile every day. And that's a little bit of what we're trying to do, and they seem to be responding well to it.
Hugh, how's price tolerance evolving? Just as you put up costs again over the last, let's say, 12 months, what's consumer price tolerance look like? Any pushback whatsoever, anywhere?
Really not very much, to be candid. If you look at the quarter, we had our prices up at about 7% and our volume growth was 5%. For the year, our prices were up 5%, and our volume growth was 4%. So actually, volume accelerated a bit. Now, I'm not going to say that's a projection going forward, but to date, consumers have been relatively insensitive to the price increases that we've taken, and I think that's because our brands are so loved and so strong, and our products are worth paying a little bit more for.
Hugh, we've seen across earnings season surprises to the upside on sales, then disappointments on earnings. Just margins haven't held up in quite the same way. What's hurting your margins at the moment? How sticky do you think that cost pressure is through 22?
Well, in the quarter, I think it was a reflection, as much as anything, of some investments that we made back in the business in order to really maintain the momentum that we have. Our advertising and marketing was up 15% because we really feel like we need to continue to connect strongly with consumers. And we continue to invest in digitalization, which makes us a stronger company that's capable of growing faster. As we look into this year and the guidance that we have, our expectation is we'll see commodities inflating right up at around 10% or so. And with that low double-digit inflation, we're going to see pricing that's in the high single-digit range. We've got all that locked in for the first 9 months of the year. And by virtue of having done that, along with our productivity programs, we expect our margins to remain intact for the course of the year.
Hugh, you're a member of the advisory council to the New York Fed as well. The Federal Reserve have been telling us that this inflation story is going to fade. Can you give me some insight into what you tell them now? Hugh, you've been at PepsiCo, I think, since the late 80s, 1987. Have you ever seen it like this before? What have you told them?
No, it's the highest inflation that I've seen. As I went back and looked in our annals, I think it's probably been the early 80s since we've seen this level of inflation. I'll share generally my view. It's difficult to predict when inflation might ease. Lots of people are out talking Q2 or Q3. Candidly, we're not sure about it, which is why we tend to forward buy our commodities by about 9 months or so. Because while I can't predict it, by virtue of buying 9 months out, I don't have to predict it. I can actually run the rest of the business based on the facts that we have around commodity inflation, as opposed to trying to guess in advance. This is a policy that we put in place about 10 years ago as a management strategy, and it's served us incredibly well, and it's serving us really well right now.
Can you predict Sunday, Rams-Bengals? Can you predict that, Hugh?
I predict we're going to have an absolutely terrific Super Bowl and an even better halftime show.
I thought so, given your affiliation with that. The PepsiCo CFO, Hugh Johnston. Hugh, thank you, sir, for catching up with us, as always. Just some insight into corporate America, the struggle they've got right now, the struggle with price pressure. Let's get you some sector price action in this equity market. For that, we can turn to Bloomberg's Abigail Doolittle.
Well, John, we have the S&P 500 well off of its greater than 1% loss lows, right now down about 0.5%. Not surprisingly, it's all about that inflation story shaping the sectors. Up top, energy up 1.2% as oil rises. You also have materials higher, and the financials getting a small bid as yields are higher. But of course, as that 10-year yield approaches 2%, you can see tech and some of the other high valuation sectors on bottom, including consumer discretionary. Utilities also not getting a bid as those high rates are competition for the dividends. Interesting on the year, though, is the roller coaster for the banks, John. The KBW Bank Index is nicely higher on the year, up about 8%. But we were talking about this yesterday. In fact, now on today, up closer to 10%. Starting off the year very strong, then dipping. That appears to have everything to do with some of those earnings reports out of the big banks and trading activity. But now you can see a nice climb higher on rising yields. Perhaps that will be the path ahead if that 10-year yield does take out 2% soon.
Abby, thank you. Equities just recovering a little bit. The S&P down 0.5%. The Nasdaq down 0.7. The yield market, the Treasury market, yields still up 5 basis points on 10s, up 10 or 11 on 2s, just off the highs of the session, 147 on 2s. From New York, your trading diary up next. In the equity market, the move improves just a little bit. Just a little bit. 25, 26 minutes in. We're down 0.5% on the S&P. On the Nasdaq, we're down 0.6%. No big unwind in the bond market, though. Look at the front end of the curve on twos. Very close to 150. Yields higher, yields up by 10, 11 basis points, and just short of 2% on a 10-year at 198.40. That's the price action. Here are the trading diary. President Biden discussing healthcare at 12:30 Eastern. The U.S. Treasury auctioning $23 billion in 30-year notes at 1 p.m. Later, we get some Fed speak from Tom Barkin, and we round out the week with the University of Michigan Consumer Sentiment Survey. From New York City this morning, good morning for our audience worldwide. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day, Thursday, February 10th. Here are the top market stories we are following for you this hour. Well, hot American wallets getting hit again with a higher than expected jump in consumer prices. Inflation charging ahead at the fastest pace since 1982. And now the spotlight is on the Fed. Money markets are betting a whole percentage point of rate hikes by July. Do traders have it right? Will March be the start of a historic tightening cycle? And is 50 basis points back on the table? And turbocharged, Aston Martin unveiling its latest Formula One car. We'll have an exclusive interview with none other than Aston Martin F1 team owner Lawrence Stroll on what they're doing to keep the momentum going. From New York, I'm Kriti Gupta with Guy Johnson, and Alex Steele is off. Welcome to Bloomberg Market.
That was a hot number, wasn't it? Certainly caught a few people on the hop. Big reaction, Critty, certainly at the front end of the curve. The curve a lot flatter. We're seeing an impact over here in Europe. The real question is, does this change the narrative for the Fed? A lot of people, Scott Minard included, talking about the fact that 50 is now on the table. I think we're pricing 50-50 on 50 for March. So let's talk about our question of the day. Is the number we've just seen peak inflation? Does it fade from here? Or is there more momentum behind the inflation narrative than we first thought? Let's bring in Bloomberg's international economics and policy correspondent Mike McKee over in New York and Bloomberg Markets editor for rates, Christine Aquino, joining me over here in London. Mike, let me start with you first of all. Is this peak inflation? Is there anything within these numbers, within this data, that we can use usefully to determine whether or not we go higher from here or fall from here?
Well, unfortunately, because there's so many categories, there isn't really a way to tell. We do have some clues, however, and there was a little bit of good news in there. We did see used car and new car prices start to moderate their increases. Used cars was the lowest increase that they've had since last September, and new car prices actually dropped a bit. So they've been a big contributor. They're about 10% of the CPI, and if that continues, that'll put some downward pressure on it. We'll see what happens with energy prices going forward. We'd had flat gas and gasoline prices during the month, so those categories went down. Energy overall was up, but it was just energy services. Rent is going to stay in there. So you're going to have to put up with the fact that home prices are going to go up. However, the Fed raising interest rates will have an impact on that sooner or later, because it'll be one of the most sensitive sectors to what the Fed does. So there are some reasons to think we might be close to peak, but it's hard to say whether it's this month or next month.
Christine, hop on in here, because the immediate reaction off of this very hot inflation report was 10-year yields getting higher and higher, nearing that 2% level. I think some contracts even trading just above. Talk to us about what that means. What is the bond market pricing in when it comes to peak inflation or perhaps persistent inflation?
Well, Critty, I think the reaction is very much reflective of the fact that the bond markets are getting another dose of reality that inflation is here to stay. And I think, you know, that reaction in the 10-year yield, potentially just a sign of more yield moves to come and more thresholds getting broken here as this flows through markets. I think it's very important as well that in terms of the shortened pricing, we are seeing that 50 basis point rate hike possibility really getting nailed on for traders, but more especially the July pricing of 100 basis points. That to me is actually more significant, because that implies that there will be at least a 25 basis point rate hike for each of the 4 Fed meetings between now and July. That's pretty significant.
Can I just clarify something here? And Critty raises it, and it's been hopefully clarified for me by Bloomberg's Cameron Kreiss, because I've been asking the question, do we get north of 2% or do we not get north of 2%? His answer to this, the old, in inverted commas, 10-year bond, which basically had a maturity 31st of the 11th, i.e. November, traded at just over 2%. The new one, again, inverted commas, auctioned yesterday, Critty, peaking at 1.9997. You need to go to 4 decimal places, as John Ferro continues to point out. But it just depends, as you say, on which one you're looking at, depending on whether or not we got north of 2%. But we haven't sent it hot yet, so we'll watch for maybe that new one to go through 2%. Christine, let me carry on with you this conversation about what the Fed does with this number. It's going to get another figure between now and the next meeting. And this comes back to our question of, does it come down from here? Is this peak inflation? Does it start to subside from here? It would have to, I'm assuming, subside significantly for the Fed to alter course, for market pricing to change significantly around this as well.
Absolutely, Guy. I think there's probably little question that the Fed will have to act one way or another in March, because market pricing has kind of pushed them toward there. And they've indicated themselves that they really are prioritizing the reaction to inflation. And so whether it's 25 or 50, that's another conversation altogether. But in terms of indicating, signaling that they will be doing something come March, that's almost
a sure thing at this point. And, you know, in terms of the question of whether this is peak inflation or not, I'm afraid it's not, you know, because I'm just listening to what we've been hearing from various companies during this earnings season, and a lot of them are declaring that they have pricing power. And so that really means that there is a potential for the second round effect of even higher prices for goods and services in the coming months, because these companies are feeling empowered to raise their prices. And so even now that the hard data is showing this is where inflation is, it's already quite hot, I'm afraid that there's potential for it to get even hotter in the next few months here.
So Mike, we'll bring you back into this conversation here. If this is peak inflation, does that mean that the Fed's original stance, the idea that inflation was actually transitory, does that kind of come back into play, or are we still concerned about simply inflation sticking around and therefore kind of justifying a more aggressive rate policy?
Well, it does justify a little bit more aggressive rate policy, and it's not just a question of whether it was transitory or not. I mean, it's been around long enough now that it's actually affecting people's lives, so the Fed is going to do what it can. There are questions about what it can do. It is, to the extent, a supply-side problem. The Fed is going to have less of an impact on that, and they want to be careful because we have gotten a lot of people back to work, and they don't want to slow the economy so much that that starts sending people away. In some ways, at this point, we're all just sort of dancing on the head of a pin because inflation goes up, the Fed raises interest rates. That's, you know, dog bites man. And whether they do it 4 meetings in a row or whether they spread it out doesn't really matter much to the overall economy, given that it works with a lag. It's more a question of how you're going to trade it than anything else.
Mike, is there a danger, though, that the Fed has to play catch-up? The Fed has already moved quite a long way relatively quickly. But is there a danger, and I'm wondering kind of what Fed speak is going to look like over the next few days, that the market needs to be lined up for even more aggressive policy? And if so, how do you see that happening? How does the communication work in the build-up over the next month or so?
The communication we've gotten in the last couple of weeks is we don't think we need to do 50 basis points at any particular meeting. That could start to change. They could start to signal that they're more open to the idea if they need to do it. They probably won't say much about doing something at every meeting because they'll want to leave their options open to see what happens with that next CPI report. And they do like the idea of pausing to be able to see what happens with the economy when they raise rates. But if the market is moving up the way it is, it's going to have an effect. We could see, certainly, we're seeing some inversion at the very high end of the curve. We could see some inversions in 210s, and if that happens, that's a signal the market thinks the Fed is going to go too far. So it might push them the other way. You can see the inflation break-evens that I was talking about earlier this morning on surveillance. You know, I said, watch these, and if they go way up, then the Fed is going to be pushed to do more sooner because they're worried about the inflation expectations becoming unmoored. And you can see what happened today. Let's see what happens over the next day or so with those. But obviously the Fed would see a problem there that they might want to address.
Christine, let's bring you back into this conversation and take it global, because overnight we also got some news that the BOJ, the Bank of Japan, is also sticking to kind of their dovish stance. We know that the ECB has kind of sort of made a hawkish pivot. What does inflation in America signal perhaps about what the inflationary trends are in the rest of the world?
Well, Kriti, you know, central bankers would want to argue, oh, we have a different regime, we have a different economy from the rest of the world, and therefore we're going to be doing monetary policy our way. That's certainly something that we heard from the Riksbank, for instance. It's the Swedish central bank earlier today arguing that it's not just going to follow in the footsteps of the ECB, for instance, which is arguably a bigger economy, or a central bank presiding over a bigger economy. It's going to go its own way because it has a different inflation profile. And I think it's going to be interesting to watch actually how these central bankers kind of diverge from each other or converge heading into the next couple of months. You know, markets are mostly uniformly moving toward the expectation that policymakers are going to have to pivot more hawkishly, but perhaps we might see a little bit of a pushback from certain central bankers in different parts of the world, and therefore creating some interesting divergences to trade off.
Well, Bloomberg's Michael McKee and Christine Aquino, thank you so much for your time. We really appreciate it with your insights as always. Coming up, we'll get another take on whether we've seen the worst of inflation. We dive into those CPI numbers with Mike Wilson, Morgan Stanley Chief U.S. Equity Strategist and CIO. This is Bloomberg.
earnings season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid.
It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
Let's get back to our question of the day. Is this peak inflation? Joining us now is Mike Wilson, Morgan Stanley Chief U.S. Equity Strategist and CIO. Mike, thank you so much for joining us. Well, let's just start there. If this is peak inflation, which I think was the consensus going into this kind of CPI report, what does that mean for the consumer? How are you thinking about this?
Yeah, I think that, we agree with the premise that the rate of change on inflation is probably peaking in a lot of these metrics. This high-frequency data is also very volatile, right? So the idea that, we're going to trade this data is that precise, I think, is a bit of a fallacy. But directionally, it's a little bit hotter. So all that really means is that the Fed is not going to be going more dovish. And I think the equity markets in the last few days have been kind of hoping that the Fed, maybe isn't going to go as quick as they were fearing a few weeks ago. And this pretty much throws cold water on that. But that's been our view all along. With whether inflation's 7.3 or 7.5%, they're going to go and they're going to go hard until they either get inflation down to a more palatable level, which is a long way from where we are, or we get markets to really break down, then they got to back off. And we're just so far from that right now that it doesn't change our view in the Fed whatsoever.
Mike, if these kinds of numbers, though, do persist, and I hear what you're saying about maybe starting to slow down, but the rate of change in the slowdown is going to be important as well. This may be the peak, but let's say the slowdown is shallower than we're anticipating at the moment. Would that change your view of how we set this market up? Because at that point, you'd have to be thinking that the Fed not only needs to be more aggressive, but needs to be more aggressive for longer and maybe generates a higher terminal rate as a result of that.
Yeah, this is the $64 trillion question. How much tightening can the Fed actually do if growth is slowing? And I think that's, so our view, we were very focused on the Fed last fall. We felt like, that was the fire part of our narrative. And now here we are. It's very consensus. The Fed is behind the curve, and by the way, the Fed's catching up in a hurry. So I think that from a good news standpoint, I would say the market now is probably pricing the Fed correctly. And I would be surprised, quite frankly, if we're able to get through all the tightening that is now being promised by not just the Fed, but the ECB and the BOJ and the BOE, all the developed, major banks. If we do all of that tightening, we're going to have a very significant slowdown, both in the economy and I think markets aren't going to take it very well. So I think the thing we're focused on now, Guy, is how much is the economy slowing, particularly in the U.S. Is the U.S. consumer going to back off here a little bit because real disposable personal income growth is going to be negative in the first half of this year for a large majority of consumers. At the same time, supply is picking up. And I actually think that we could be surprised over the next 6 months how fast inflation comes down as pricing power fades when supply picks up and demand comes down. Now, is that a good thing for stocks? It could be for some because rates come down and maybe that, or at least the expectations on the terminal rate maybe doesn't have to go up anymore. But I think the earnings disappointment, if it's bad, will rule the day, and that's why we continue to be a bit skeptical on S&P 500 at 4,500. We don't think that's great risk reward here.
Mike, let's stick with that theme of slowdowns and that supply buildup. I really want to talk about inventories here when it comes to a lot of these earnings stories. How do you interpret that going into the year ahead? Let's say we have the next, hypothetically, 6 months really focused in on the Fed and kind of the monetary policy there. After that, how much does inventories play into simply the valuations and the way that the stock market trades?
Well, it depends on the sector. Obviously, some sectors don't have any inventory. It's just the way they run their business, whether it be services or some of these asset-light type businesses. And so for those industries, it's not really going to be that big of a deal. And think about it this way. So look, building inventories is bullish for the economy, but it's not necessarily great for earnings. It's a mirror image of what we experienced coming out of the pandemic when inventories couldn't keep up with the excessive demand. But now, of course, inventories are going to catch up, and as demand is fading, not a recession by any stretch, but it will create, oversupply in certain industries. I think consumer goods, some of the, maybe the industrial supply chain, some of the housing supply chain, that's where you're going to see perhaps margin pressure. So even though you have a decent economic situation because inventories are, it's GDP growth, it doesn't translate into earnings growth. In fact, it could translate into earnings revisions to the downside as operating leverage turns negative for a good chunk of the market. That's what we're focused on. We don't know the answer to this yet, but that is the risk that people are not focused on. Just like they're overly focused now on the Fed and inflation. That was the story 6 months ago, okay? I mean, that's what you should have been paying attention to then. A lot of that has now been priced in the bond market for sure, and even within the equity market, given the de-rating that's happened for the high multiple stocks.
The other end of the high multiple stocks is the energy sector. If you've been outperforming this year, Mike, you've got to have been in the energy sector. The president called Saudi Arabia yesterday. The conversation, I'm sure, at some point turned to the possibility of more oil coming onto the market. What is your outlook from looking at this market through the lens of the oil markets and thinking about how the energy story is going to be driven from here? Do energy stocks keep outperforming even if energy prices come a little bit lower? This is a core area of the market right now in terms of outperformance. Does it stay that way?
Well, it feels that way for sure. I mean, this is clearly an area we've underinvested in. I think it's very, it's becoming more clear that while ESG and, particularly E part, moving to alternative fuels is a desired goal, it's going to take a long time. And we probably didn't invest enough in fossil fuels to make that transition smooth. So that's the bullish intermediate term view, which we, kind of share. I think that's a very bullish view for crude to go higher over the next several years. I think that's good for energy stocks. I think the short-term risk for energy stocks is that once again, this slowdown that we're seeing right now perhaps even backs up into the energy market as demand pulls back a bit and we have a little bit of a hiccup. I mean, it'll be short-lived, I think. Be a buying opportunity as far as I can tell. And then, of course, the big, sort of elephant in the room is, what's going on overseas in Russia and Ukraine. I mean, there's definitely some geopolitical risk premium in the price of crude. The question is how much. Nobody knows, but it's probably $5-10.
Mike, let's stick with the theme of energy, of course. So for oil stocks, it's a great thing to see. But what about the rest of the market? At what point do these surging energy prices become more of a headwind for the consumer or a headwind for corporate America and eat into their bottom line?
Well, I mean, look, energy is one component of inflation for sure. So the way I would think about it is if you look at consumer confidence numbers and you look at the surveys of small businesses in particular, these two entities, have to eat the pricing. The confidence numbers are through the floor, mainly because prices are too high. We've never seen readings this high in terms of pessimism around inflation from the consumer or these small businesses. The energy is part of that. It's not the only thing. Is there a magic number on crude that says, okay, we're gonna, things are gonna flip over now and we get real demand destruction? There's all kinds of estimates out there. My simple rule of thumb in the U.S. is that once gasoline prices hit about $4 at the pump, on average, we're not there yet, that's when you start to see demand destruction for gasoline, which of course is one of the biggest components of demand for crude oil.
Mike, just wrapping things up a little bit, and coming at this from the earnings point of view, earnings have been super strong over the last 18 months. How symmetrical do you think it's going to be going forward? Almost a bit like the sort of the Fed target. Have we had pull forward? Is that what the last 18 months were about? And if so, from an earnings point of view, thinking going forward, do we get the opposite and equal reaction?
Yeah, it's interesting. I mean, in April of 2020, we were kind of the earnings bull on this positive operating leverage story. And I would say people were slow on the draw on that. It took a long time. And quite frankly, we underestimated how much operating leverage there was. It's just been a phenomenal run. So I think it would be naive to suggest that if we have the normal kind of, roll coming off the boil, if you will, slowdown that you typically at this time of the expansion, that there should be some negative impact on the other side. The payback in demand is one argument. The consumer income growth is another argument. And then the inventory build, which could put pressure on pricing, which is really where all the over-earning came from. It was pricing. There was no discounting because of the shortage. So all three of those are going to play into what I think is not a complete mirror image guy, but definitely some payback. And I'll just leave you with one last thought as we think about where's that payback the greatest? Just remember, there's a little bit of Peloton in everyone, okay? Everybody benefited a bit from the pandemic. There's a little bit of over-earning from everyone. And so we're seeing a little bit of that in the earnings season now with other companies kind of admitting to this. And my guess is, that hasn't finished playing out.
A little bit of Peloton in all of us. Mike, on that note, we will leave it. Thank you very much indeed. Great stuff as ever. Mike Wilson of Morgan Stanley, thank you very much. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Twitter sales rose 22% in the fourth quarter. Their social networks ad business held up despite changes to Apple's data collection rules that have hurt some of Twitter's larger rivals. Still, first quarter revenue may fall short of expectations. And it's a sign that Coca-Cola is benefiting from a return to normalcy despite the lingering pandemic. The beverage giant posted fourth quarter sales that beat estimates. Coke says it expects inflated commodity costs to continue this year. And Elon Musk's SpaceX has lost dozens of satellites to a geomagnetic storm. As many as 40 of the 49 Starlink satellites launched on February the 3rd were hit by a storm the next day. SpaceX says the satellites either re-entered the Earth's atmosphere or are on track to do so, burning up in the process. And that is your latest business flash. Guy?
Ritika, thank you very much indeed. Kriti, this is going to be good news for NASA. I think NASA's a little bit worried that Elon Musk is putting maybe too many satellites in space. Apparently, we're not going to be able to see rogue asteroids coming towards us as a result of this crowded low-orbit space that we're now creating.
You know, it's kind of wild to me that we're in an era where we have this much space debris in our orbit, because I just remember not too long ago, I think we just had the International Space Station. That was kind of the only thing up there, right, Guy?
Yep, and you could see it. We used to use it for my children to say that it was Christmas. That was Santa up there. You could see the IS flying across the sky. Anyway, we're going to talk more about the Fed next. This is Bloomberg.